Not all bonds are the same. When most people think of bonds, they think of government bonds, safe, predictable, boring, but the reality of institutional fixed income markets is far more interesting. Pension funds, insurance companies, asset managers, and sovereign wealth funds invest across a wide range of bond types, each with different risk profiles, different yields, and different roles in a portfolio. In this video, I'm going to walk you through the main categories of bonds that institutional investors work with every day, and more importantly, why each type exists and what role it plays in a real institutional portfolio. Let's start with government bonds. Government bonds are issued by national governments to finance public spending. They are considered the safest fixed income instruments available because they are backed by the full faith and credit of a sovereign state. Examples include U.S. Treasury bonds, German bonds, UK gilts, French OATs, Japanese government bonds, and Indian government securities. These are the benchmarks against which all other bonds are priced. When you hear that a corporate bond trades at 150 basis points over government bonds, it means its yield is 1.5% higher than the equivalent government bond. For institutional investors, government bonds serve two primary purposes. First, they provide a safe liquid core to the portfolio. Second, they are the main instrument for duration management and liability matching. An insurance company or pension fund with long-dated liabilities will hold significant amounts of long-dated government bonds to match the duration of those obligations. Now let's look at corporate bonds. Corporate bonds are issued by companies to raise capital. Because companies carry more risk than governments, they can go bankrupt. Their revenues can fall. Corporate bonds pay a higher yield than government bonds. That extra yield is called the credit spread. Corporate bonds are divided into two broad categories. Investment-grade bonds are issued by companies with strong balance sheets and low probability of default. They are rated B, BB- or above by rating agencies like Moody's, S&P, and Fitch. High-yield bonds, also called speculative grade or junk bonds, are issued by companies with weaker financials and higher default risk. They offer significantly higher yields to compensate for that risk. For institutional investors like insurance companies and pension funds, investment-grade corporate bonds are a core allocation. They offer higher yields than government bonds while maintaining acceptable credit quality and regulatory capital efficiency under frameworks like Solvency II and risk-based capital. Covered bonds deserve special attention because they are particularly important for European institutional investors. A covered bond is a bond issued by a bank and backed by a pool of high-quality assets. Typically mortgage loans or public sector loans. Unlike a standard corporate bond, if the issuing bank fails, the bondholder has a claim on both the bank and the underlying pool of assets. This dual recourse makes covered bonds significantly safer than regular corporate bonds. Covered bonds are widely used in Europe, particularly in Germany where they are called Pfandbrief, and in Scandinavia. They offer yields slightly above government bonds while carrying very low credit risk and favorable capital treatment under Solvency II. For insurance companies looking for safe, liquid assets with a yield pickup over government bonds, covered bonds are an essential tool. Supranational bonds are issued by international institutions rather than governments or companies. Examples include bonds issued by the European Investment Bank, the World Bank, and the International Monetary Fund. These institutions have very high credit ratings, typically AAA, because they are backed by multiple sovereign member states. Supranational bonds are considered almost as safe as the highest-rated government bonds, but often offer a small yield premium. For institutional investors seeking high-quality assets with slightly better returns than core government bonds, supranational bonds are an attractive option. Finally, inflation-linked bonds. Inflation-linked bonds are government bonds whose principal and coupon payments are adjusted for inflation. In the United States, they are called TIPS, Treasury Inflation Protected Securities. In the United Kingdom, they are called index-linked gilts. For institutional investors with inflation-linked liabilities, such as pension funds that promise inflation-adjusted retirement benefits, inflation-linked bonds are essential. They provide a natural hedge against inflation risk. If inflation rises, the bond payments rise too, protecting the real value of the portfolio. Each of these bond types plays a specific role in an institutional portfolio. Government bonds for safety, liquidity, and duration management. Corporate bonds for yield pickup within acceptable credit risk. Covered bonds for high-quality assets with better returns than government bonds, supranational bonds for AAA quality with a small premium, and inflation-linked bonds for protection against inflation in liability-driven portfolios. Understanding which bond type to use and why is one of the most fundamental skills in institutional fixed income portfolio management. If you want to go deeper, how bonds are analyzed, how credit spreads work, and how Bloomberg is used to evaluate bonds in real institutional portfolios, subscribe to this channel. We publish weekly videos on fixed income and institutional investing. And if you want a structured learning path, check the link in the description.